So welcome everyone today to iBailey and specifically to our webinar. I think today we're going to be focusing on the different energy provisions in the Inflation Reduction Act. Just maybe like to highlight a couple of things before we dive too far into it. A couple of things. One, this is a series of webinars we've been doing. Our first webinar was about a month ago, and it covered the carbon capture and sequestration credit. We're not going to cover that today, but that webinar is pre-recorded, and so you can access it, I think, through iBailey, and maybe Amy can provide details on that. And there's a slide deck there as well. So if you've come specifically for that credit, maybe stay with us today, and then you can look back to that webinar. And then the second thing I'd say is one of the very exciting parts of the IRA, the Inflation Reduction Act, is new opportunities for tax-exempt entities. From a federal perspective, tax-exempt entities could not really participate in the tax credit and incentive space. They didn't have taxable income. I mean, states was for state income tax a little different, but from a federal perspective, really they weren't in the ball game, and that is now all changed with the IRA. So if that's piquing some interest, join us on November 28th, because we're going to have a whole hour webinar geared just to tax exempts and the opportunities with the IRA. So here are our presenters for today. I'm Adam Sweet. I'm a principal. I'm in Spokane, part of our national tax office. I kind of do a whole bunch of different things, but for today, I'm going to try to be a decent moderator and maybe ask questions when they seem obvious to ask. Maybe if my other panelists could also provide a brief introduction. Maybe start with Mark.
Yeah, thanks, Adam. I am Mark Rogers, principal in our Business Credits and Incentives group. I'm out of Chicago. I focus primarily on deductions and credits in the built environment. When someone builds, renovates, or acquires, that's where I'll come in and try to get those credits and deductions. Jim?
Well, thank you, Mark. My name is Jim Donovan. I'm a partner in the National Tax Office or Business Credits and Incentives. I mainly focus on R&D tax credits and the employee retention credit, but these energy credits they dovetail nicely with our other practices. I am based out of our Minneapolis office, but hide in the great state of Iowa. Mel.
Yes, I'm Mel Schwartz, the Director of Legislative Affairs for iBailey. I've been here in Washington, D.C. for close to 35 years now. And during that time have spent most of it following Congress, following what Congress does, and as now is very appropriate with this period today, discussing what we do with what Congress has done. I will admit that the background behind me is not in the District of Columbia. It is our satellite office in Maine, but it is nonetheless, I think, more pleasant than simply showing you the side of the building that is the view outside of our office here.
So just as an agenda item from today, so I think we're going to start with trying to explain legislatively how we got here. I think everyone remembers the Build Back Better from last fall, and that was a pretty mammoth piece of legislation. And we all were kind of holding our breath to see if that was going to be passed or not passed. Ultimately, Build Back Better was not passed. We ended up with the Inflation Reduction Act. But as long as if Mel's audio is back, then I think he's going to give us a very nice run through.
Yeah. Can you hear me now?
I got you, Mel. Perfect.
Okay, wonderful.
So Mel will do that, and then Jim is going to dive into some of the IRA specifics, the different incentives that were brought forth through the IRA, some of the opportunities. Then I think Mark's going to spend the bulk of the time highlighting the immediate opportunities we see, specifically with 45L and 179D. If those aren't ringing a bell, we're going to spend a good 20-25 minutes at the end explaining what those are and why we see those as such a big opportunity. So with that, since we have Mel back, Mel, maybe you can walk us through how we got from Build Back Better to the IRA.
All righty then. And indeed, how we started out, of course, with all this was was with the Build Back Better. When the president came in, there was a proposal for, as you can see here, over $3 trillion worth of programs that included green energy. Unfortunately, to go that deep, that would require a collection corresponding increase in a number of pay-fors. That turned out to be more than Congress was ready for. I think perhaps more than the country was ready for. Build Back Better was not enacted. With regard to the energy side, we do finally, though, see the Inflation Reduction Act as we passed here in August. Now, the Inflation Reduction Act, at least compared to the BB, does not include the bulk of the tax increases, the revenue raisers that people were concerned about. We don't have a statutory rate increase. We don't have massive changes to the way gift and estate taxes work. No change in the SALT deduction, no change in the carried interest rules were some other things that had grown attraction. What we do see, a couple of revenue raisers. Instead of an increase in the corporate tax rate, we see a corporate minimum tax based on book income, but not one that would affect businesses less than $1 billion. We see a share buyback tax, 5%. But by that token, it only applies to those regular C-type corporations, which are listed on an exchange. There is some additional money for the IRS. The IRS is not quite sure how they're going to spend it all yet, but that is intended to both beef up taxpayer service, which hopefully will help taxpayers do a better job of reporting their income, and also some level of increased enforcement. Although there's going to be a lot of pressure on the IRS to show results from that increased examination money. And consequently, I think we're going to be seeing that focusing in much more on the higher end of the income spectrum than perhaps the average small business. But we did get, and what is really preserved from the Build Back Better was almost $400 billion over 10 years of various incentives to promote energy efficiency, to promote the green energy world. Now, we're going to be going into some of these items in more depth later. There's going to be, as Adam said, we're going to have additional webcasts coming up later. But let's just talk for a minute about some of the themes that are constantly running through the various energy incentives that were added by the legislation without necessarily getting into the specific details of each one. For virtually all of these, there is going to be a requirement that if you want the full amount of the credit, you're going to have to meet wage and apprenticeship requirements, primarily focused on the wages and the use of apprentices on the labor sector of the, not necessarily the management, but the labor sector of these activities. There are going to be some bonuses over and above what would otherwise be the credit, the incentive available if you meet domestic content standards. There are also going to be some bonuses based on geographic. Now, because there are so many different new ones, there is a certain amount of overlap between some of these credits. The legislation is careful to at least try and indicate that we're not going to be allowed for, there's no double dipping going to be allowed. For instance, if you are getting a credit for building, the cost of building a plant, cost of building a plant to make, let's say, windmill blades, you're not going to be able to get a credit for making and selling the windmill blades. On the other hand, if you don't claim the credit on the front end, then maybe you will be able, but you can't have both. And that's what the no double dipping here is about. There are going to be choices that are going to need to be made. There's an analysis that's going to need to occur to make sure that you are getting the right and the most beneficial credit that is available. Very big change. Credits, these new energy credits can be monetized. And we'll get into that a little bit later as to the techniques that may be used for that. For tax exempts, virtually any of these new credits can be claimed essentially as an amount of tax paid and claim it on the tax return, whether you would otherwise file whether the tax exempt would otherwise file that kind of a tax return or not. For other taxpayers, most of these can be sold. They can be sold for cash and rather than claimed as a credit. But this is not the last word. We're not going to be able to tell you in this and the other webcasts in our series everything that is here. We are going to need to hang in there. Oh, I'm sorry. Here's a mention with regard to the incentive monetization. And again, as I think this slide points out, there is potentially a change, but not necessarily a change in how this is approached. Federal tax credits, previously there was always an effort on the part of the government, on the part of Congress, to keep you from just buying and selling these things. The credit was for the taxpayer that did what it's supposed to be, not something to be sent off. Now, the so-called flip partnership, which would involve investment by partners that could better utilize the credit in the first part of the investment and then flip out of that structure, came to be commonly used. And certainly that is something that is continued to be there. But this introduction of monetization, direct pay or transferability for cash, is going to open up a new avenue to claiming the benefits of these credits. Now, how's the market going to adapt to these new provisions? Well, we're not sure. We could use some government guidance as to how all this is going to work. And I think that since this is a market that has not existed before, we don't really know how the pricing is going to work. Fortunately, we're not necessarily going to need an election with regard to this. This is going to apply to credits that are generated in 2023 and later. It does not look like we're going to need to decide how to approach those until we get later in the year. And so consequently, it may well be that we will have some opportunities to see how the product develops, to see how the system develops, and then make a reasonable choice. Let's talk a minute about timelines. There are different end dates for various of the provisions. The traditional investment tax credit and production tax credits are going to expire unless your program commences prior to January 1 of 2025. But in fact, there are new credits that are intended to take the place for them. And we will see those presumably coming in effective in 2025. Now, do we have the final word on how that transition is going to take place? No, we do not. But it is something that we need to be looking out for, and I would expect this is going to go on. Now, with respect to almost everything else, we're really talking about a start date of 2023, excuse me, continuing through 2032. The 2032 cutoff reflects the parliamentary requirement that was necessary in order to move the thing through the legislation through the Senate, and should not be taken as a policy statement that there's a desire to have these in any way go away.
Maybe one question for you, Mel, but do you think that highlights on that previous slide? I know in a second we're going to talk with Mark about some of the immediate opportunities, but you look at this timeline and there could be other opportunities that may be, several years away, right, before a project starting, depending on the credit or what you're looking for. So is it fair to say it's not all just immediate, ready to go?
No, it is by no means is it all just immediate. I mean, a number of these projects are going to require planning. They're going to require time to construction. Notably, it is the date that construction commences that is typically the trigger date and not a placed in service date. So even if we're talking about provisions that have an end date associated with them, the ability to at least get the process started, and we can look at some of the traditional rules that they've used, that the IRS has used for determining that. It is going to, we still have a good runway in order to try and establish these provisions. Just mentioning, and that is also, I think, going to take place of, we're going to need to hear how the IRS is going to interpret a lot of these things. We're going to need new forms. We're going to need a lot of guidance. Some of these incentives kind of intersect with each other. For instance, you can capture carbon, but the carbon what if you use the carbon that you capture for some other purpose, like in associating with hydrogen production, which hydrogen fuel is going to be a goal here. How are those going to fit together? We've said that there's a goal to keep you, there is a goal to keep you from double dipping, but does that apply to stacking one incentive on top of another if they relate to different things? We expect guidance. There is already an opportunity to comment on that guidance, but a lot of the details are going to remain open and are ones that we certainly here at iBailey will continue to follow, and will hopefully be able to pass these along to you as they develop.
And
Adam, let me.
I was gonna say it's a key point too, right? Even with tax reform back in 17, I think from a client perspective, everyone assumes Congress passes something and it must be good to go, right? And I think especially in the tax arena, you know, a very large percentage of it is really back to the Treasury Department and the IRS to implement. I mean, is that a fair statement?
That is fair, and I think that was particularly fair here because if you think back to this summer, the legislation was considered dead. And then sort of overnight, it sprang back to life and was enacted very, very quickly. And yes, the ideas had been kicking around for 18 months or so. But that point where you have to get it on paper and it has to be exactly right, I'm not sure Congress was quite there when they went ahead and enacted the legislation. And so that leaves open some open questions. And of course, there are also smart minds work for private industry as well. And it may be that we'll think of some things that Congress didn't. And that always provides both opportunity and sometimes some challenge.
Yeah, so maybe we'll turn it over to Jim. Sorry, Mel, to interrupt, but
No, that's fine. Yes, Jim, some specifics. What are you going to guide us through today?
Well, thank you, Mel. And so, you know, we're really going to follow off what you shared, right? There are certain metrics or criteria that you need to meet to really take full advantage of the ITCs and the PTCs that are in the IRA, right? So I'm going to walk through, gosh, what is an investment tax credit? What's a production tax credit? What are some differences? We'll hit on a few of the highlights. But really, we'll start with a general discussion, and then we'll get into some details, and then we'll talk about, gosh, how does this benefit me, Jim? What do I need to do to take advantage of these credits, right? So let me just advance the slide here. So really, talking about the overview, what is a production tax credit versus an investment tax credit, right? Production tax credits generally a credit on something produced, right? In our example here, if you produce wind energy, right, you have a bunch of windmills out there, you're going to get a credit based on each kilowatt hour produced. The difference is with an investment tax credit, generally you're going to get a credit on the cost basis of the qualifying project. So now if you put up solar panels, right, you're going to get a credit based on the cost of those solar panels. The one difference, or one just immediate difference, is if you claim an ITC, generally you have to reduce your basis, which means less depreciation, right? So, really when you're factoring these out, because Mel talked about, gosh, there's a lot of overlap here, right? You're trying to figure out what's the best option for me because there's no double dipping. There are a lot of things that go into that decision as to whether I should take advantage of an ITC and get the cash sooner, or a production tax credit and earn the credit on the back end over a longer period of time, which really kind of gets me into my next slide, which, does talk about the timing, right? So in ITC, again, you're going to get an immediate value. It's going to be, construction is started or placed in service, right? So you get that credit up front versus, again, the PTC you're going to get on the back end, maybe over 10 years. Again, no double dipping, right? But look at your solar panels here for just one quick example. If your solar panels cost $100, right? Maybe you can get an investment tax credit right off the bat for $30. Assuming a 30% credit rate, right? But maybe the better answer is, gosh, you know what? I'm going to wait until the energy is produced, and I'm selling that energy, and gosh, I'm going to get a $75 credit per year over 10 years, right? So again, you got to talk to your stakeholders and understand, hey, what's my time horizon here? What's going to be the best value for me? Do I need it? Do I need the return now, or can we push it down the road a little bit?
And Jim, maybe a question for you. I mean, two questions. One, maybe talk about the importance of modeling. And then secondly, do you think the answer of a PTC versus ITC could depend on the particular credit and I suppose, or the project?
Absolutely. Adam, you hit the nail on the head, right? So in terms, it's really going to be each individual taxpayer organization really needs to look at what are the goals, sit down with stakeholders, understand, okay, what's the cost of the project? What is the goal of the project? What incentives apply, right? Is it, carbon capture and sequestration, or is it going to be an energy investment tax credit, right? So again, looking at the goals, what stakeholders need, and then you're going to have to model it out. There's going to have to be some discounting involved in, gosh, what is the value of the production tax credit on the back end versus the investment tax credit in the beginning. And that's going to be part of the process that iBailey assists with. And I'll get into that in a couple slides, but absolutely, there's no clear-cut answer that you say, hey, gosh, we're going to put up a bunch of windmills or put up solar panels. Clearly, I need to take PTC or ITC, right? There's just a lot of factors that layer into that, as well as Mel mentioned credit stacking, right? So what other incentives can I factor in to maximize that return on investment? All right. So you know what? I know we don't have time to actually walk through all of these tax credits in a lot of detail. I will share that, a lot of the percentages I'll throw out are based on meeting prevailing wage and apprenticeship requirements that Mel mentioned, right? Otherwise, you can get a much smaller credit. In some cases, it's a 30% credit if you meet those requirements. Otherwise, it's a 6% credit on the ITC side. And that's a huge difference, right? If you're investing all your money into this project, is it worth it to go with a cheaper wage rate? And maybe, based on the dollars invested here, the answer might be a resounding no, right? So I'll hit some of the highlights that I think are most applicable. And I'm going to start with the energy investment credit. So Section 48. It's not new law, but it's kind of extended and expanded law here. And this is a credit for building or installing wind, solar, biogas, dynamic glass, geothermal, energy storage facilities, waste energy recovery property. There's a lot of things that roll into this. If it's placed in service after 2022, generally it's a 30% credit. Now, there's also an additional 20%, Mel mentioned domestic content, right, or being an energy community. So, gosh, now you're talking potentially a 50% credit, right? So it's pretty lucrative, and again, it's fairly large or fairly encompassing in terms of what can qualify. Also want to highlight the 48C credit. So this advanced energy project tax credit, and again, sorry, these are investment tax credits, right? You get the credit for basically building them. It's based on the cost basis, but 48C is a bit of a unique animal. in that it's not just, there's a pool of funds, right? So Treasury is going to apportion out this $10 billion pool of funds to qualified projects. And you know, what's going to be a qualifying advanced energy project? Well, we're waiting for guidance, right? We have some ideas, but ultimately we have to wait for what the IRS comes up with, right? Property must be placed in service within 2 years of certification. Again, that certifying process is unique. In a lot of the ITC projects, there's no certification needed. And again, we don't know what all those requirements are going to be. I will highlight again that, you know, if you meet prevailing wage and the apprenticeship requirements, again, it's a 30% credit, or again, up to 50%, right? Or gosh, it's an 80% reduction if you don't meet that criteria. So, you know, you do want a partner here to help you make sure that you are checking all the boxes to maximize your credit. All right, I'm going to flip over and talk about some of the production tax credits. So again, you know, the investment tax credit, hey, I put something in service, I get a credit on the cost basis, you know, reduce that tax basis, so less depreciation. But the production tax credits, right, this is, you know, you create and sell something, then you can get a credit on it, right? So, you know, I'll start with, you know, the production tax credit, right? 45, again, not new, but expanded, kind of reinvigorated here, right? You know, in this case, it's a mirror of 48. So you have 48 if you want the ITC up front, 45 is if you want the production credit on the back end. You know, it's up to a $27.50 per kilowatt, or per megawatt produced. And it could be up to $33 if certain criteria is met, and that it is adjusted for inflation. So again, something to think about. Gosh, okay, well, how much am I going to produce versus how much did it cost to build? Maybe the answer is a better credit on the back end. Also going to talk briefly about carbon capture and sequestration. Like Adam said, there is a webinar we did a couple of months ago on that, and I strongly recommend you listen to it. Just know that the IRA did increase the rates in this. So now it's $85 per metric ton of, you know, carbon captured and sequestered, and $60 per metric ton if it's reused. And if you capture it via direct air, the credit's just significantly higher. This credit's earned over a 12-year period, and it's indexed for inflation. You know, we've done some modeling on CCS, and the numbers can be huge. So again, this is one where it's like, maybe I want to take the PTC. The other one I'll mention here is the advanced manufacturing production tax credit. So this is a mirror to 48C that we just talked about, that unique animal right. This is the production credit that can be earned on the back end if you elect to skip 48C, because the reality is Congress is going to, or sorry, Treasury is going to apportion those funds, right? Let's say they get more than $10 billion. Maybe you don't get your entire amount. Maybe you get a pro rata portion. We just don't know how that's going to work, right? So maybe you want to take your chances with the production tax credit on the back end. There's a table of rates on that one, so I won't get into the details there. The last one I'll mention is the clean electricity production tax credit. And again, this is a mirror to 48E, which was in the previous slide. Again, no double dipping, but you know, it's a $26 per megawatt hour of electricity generated versus the 30% ITC that was in the prior slide. So again, opportunities here to actually really maximize that return on investment, right, for investing in clean energy. So circling back to the question, you know, what's best, right? The real answer is there's no easy answer. It's going to depend on your goals, what stakeholders need, and the reality is you're going to have to model out the benefit. And so that's why I will bring in Bailey's eco process here. So it's cleverly named, right? Eco, courtesy of Mark Rogers. And in this process, we explore your needs with key stakeholders and really clarify and confirm goals, as well as identify the pain points, right? And the timeline for your project. And we do all that in the explore stage. Hey, look, what's going to be the plan here? And once you kind of flip from, okay, this is an idea to, hey, we're going to go forward with this. This is where we hop into the create stage. And this is really where we do a lot of the modeling. We identify other incentives that you can stack. And really, again, hey, let's maximize the value. And then that final phase is operate, right? And so during the operate phase, now it's up and running. How do we take advantage of that production tax credit or the other incentives that happen on the back end, right? Or make sure we're meeting all the criteria as we go along for the ITCs or, the other things. Again, we don't want to mess up and miss out on a 30% credit and have a 6% credit, right? Because your stakeholders would maybe say that, gosh, you know what, we should have killed the project if that was going to be the return. So again, these are complicated rules. We don't even have all the guidance yet, right? And we recommend you partner with someone like Guy Bailey, who has engineers on staff who can really help you through this process. So what I'm going to do now, though, is turn it over to a less gray area. Mr. Mark Rogers will actually talk about, gosh, 179D and 45L, which there is an immediate play for those right now versus some of this stuff. You're not going to be building this stuff right away, right? You're probably in the early stages, and it looks like we have a first polling question too.
Yeah, while everyone maybe tackles that first difficult polling question, just as an intro to Mark, maybe Mark, you can give just a quick, what is 170, and I know you have more slides, but starting off, what's 179D, what is 45L, and why are we excited about it, and why is the industry excited about it immediately?
Great question, Ed, and thank you, Jim and Mel. Glad to be here talking 45L and 179D. What they are, in essence, are opportunities to incentivize energy efficient construction. And while we get our arms around the 700 plus pages of the IRA, the one thing these two have in common is we can take advantage of them tomorrow, right away. So we're going to spend the next 20 minutes or so digging into these two and how we can take advantage of them. So the sections 179D and 45L, these are just numbers and letters, and in the accounting world, that's how we kind of rule the day. But really, what 179D is energy efficient commercial buildings deduction. So throughout this presentation, you'll see some form of 179D or energy 179D or just buildings deduction, but we'll be talking all about the same thing. And then 45L, what that really is in the code is the new energy efficient home credit. So while the deduction reduces taxable income, the credit reduces taxes dollar for dollar. So the credit, a lot more powerful. With that said, both are powerful tools to use in your tax strategy year in and year out. Okay, let's talk about certainty. This is something we have not had with energy efficient credits and deductions since they came on board in 2006. So 179D and 45L were introduced in the energy policy of 2005. And you can start taking advantage of those two incentives, Jan 1, 2006. Every year after that, they were bundled in with annual tax extenders. And there might have been 40, 50 of these extenders, and who knew if they were going to be extended or not. Sometimes we didn't find out until January or February of the year after if they were good for the year before. And so they're kind of in limbo. They always did get extended though. But builders, developers, architects can never rely on it for their tax strategy. There wasn't that level of certainty. In 2021, that changed a bit for 179D. In the Consolidated Appropriations Act, it was made permanent, which is a great thing. It was made permanent at $1.80, and then in future years adjusted for inflation. So you started to get that certainty, which was a wonderful thing. 45L, we weren't sure. In fact, we weren't sure about 45L until the Inflation Reduction Act. So for all of 22, up till August, when the IRA came out, we didn't know if it was going to go through Congress or not. And we were happy to see it is. And so in 2022, it's extended out. And then in 23, it gets enhanced. Not only does the 45L get enhanced starting in 2023, but so does 179D. And those enhancements are good through 2032. So imagine, and it's a big deal. We've never had that before. 10 years of certainty. And imagine what you can do with 10 years of certainty. Accounting and tax departments, you can proactively plan for these incentives in your capitalization policy and fixed asset ledgers. Developers, owners, contractors, architects, you can proactively plan for these incentives during design and construction. So nice to have. Another one, 10 years of materiality. So again, feeding from the last slide, 179D and 45L were enhanced through 32. That enhancement just wasn't a timing thing, it was a money thing. So the 179D, which is currently at $1.88 through 22, that's adjusted from $1.80, is now in 23 to 32 going to go to $5 a square foot. So now we have the certainty and the materiality around 179D. And then on the 45L side, it goes up from 2,000 in 2022 to as high as 5,000 in 23 and 32. So I'd say this, on the 45L side, materiality was never a problem. $2,000 per unit is a wonderful thing. And surely we'll take the 5,000 now. On the 179D, we did see with somewhere maybe the bigger Fortune 500, 100 companies where the $1.88 really wasn't doing it, the $5 certainly will. So
what does it take, Mark? Let's say someone out there has a project right now they're building and they're going to place it into service next year. Would they be eligible for these new benefits, or would they be only eligible for the old credits?
That is a great question. So we do have some clients who have building, place, and service dates at the end of December. I said, gosh, can you just wait to January 1st? So it is a placed in service with both of these. 45L used to be a leased up situation or a sold unit, but now in 23 will be a place in service. So the minute it's placed in service, typically you have your certificate of occupancy at that point, or it's ready to be rented out or used. Then that's when you can, in that tax year, that is when you can claim the credit or deduction.
And it is that placed in service, we talk about it like it's there's a standard for what placed in service means. There's a statutory and regulatory standard, but maybe the point there is someone could have been building something right now, they're going to finish it next February, and potentially, Mark, they're walking into a whole bunch more credit. I mean, if they're eligible, than they maybe were expecting.
Absolutely. And what's better is these incentives, chances are that if you're building energy efficiently, and we'll get into that a little bit, you could walk right into those credit deductions right away. So again, immediate. And again, just with like a certainty, imagine what you can do with certainty. Well, imagine what you can do with 10 years of materiality. Accounting and tax departments, you can achieve cash flow through tax savings and contribute to your company's ESG efforts on a 10-year level. Developers, owners, contractors, and architects, you can design and build sustainably while decreasing your tax liability. And know that's going to offset, wash, and maybe even net you something. probably net you a lot the way it's shaken out. All right, we talk about certainty, we talk about materiality. Now we're going to talk about the concept of stacking. You heard a lot about no double dipping. Not quite the case with 45L and 179D. Stacking is allowed. Stacking allows you to take incentives in a project at the same time without sacrificing one incentive for another. Said another way, you can have your cake and eat it too. And here and we can do this with any number of industries. I chose 3 popular ones right now with the IRA, residential, manufacturing, nonprofit. But you can take a 45L credit with residential and a 179D deduction at the same time. There's fact patterns now where those line up. Before the IRA wasn't stackable. And of course, other bread and butter type incentives like cost segregation, partial dispositions, repair and maintenance, and utilities sales tax exemption, all can be stacked at the same time during one project. You know, I often hear, I don't care what's called, just monetize as much as you can. Well, this is how you do it, through stacking. On the manufacturing front, 179D, we stacked on cost seg and qualified improvement property, which came out of the CARES Act. And again, the partials and the repairs and utilities sales tax exemption. You get the idea. Where things get really interesting on the nonprofit side, think education, higher education, K through 12, healthcare, senior living. Some of those nonprofit sectors can now monetize. You heard a little bit about that from Mel and Jem, the 48 energy credit, the ERC, which I hope everyone is looking into. And then on the 179D front, something we're calling Energy Deduction Allocation Program, nonprofits now have the power at their sole discretion to allocate deductions to architects and engineers. So something that needs to be thought out and not just handed away or signed off on from a nonprofit. And again, November 28th, we're going to spend a whole hour talking about the healthcare industry, higher education, K through 12, and other nonprofit government. There. Okay. Let's dive into 45L, an overview. $5,000 to $5,000 credit per unit. In 2022 has to be 3 stories or less. But that changes in 23 to 32. It's all sold or leased in an open tax year. That's going to be placed in service after 2023. We typically move on projects that are 10 plus units because it just yields a better value proposition, but no reason less than that can't achieve the 45L. The first step is a discovery call. This is not a slam dunk. Those who have done cost segregations or some of these older incentives in the past know that that is a slam dunk. 45L isn't. It's good to have a discovery call, see what's there, and then do a provisional assessment. And what does that provisional assessment look like? So here at iBailey, we do have a tool based on municipality, city, state, of run and by climate zone and building code of running, and we run that tool to see if it's viable. Are you doing the things that need to be done to get this credit? And on the flip side, if you're not, what can you do to change that? And we write a memo on that. Some positive factors: hydronic heating, reflective coatings, HVAC efficiency, 2x6 construction, attic insulation. And from there, if things are looking good, then you go through a certification process. You're looking at drawings, you're looking at specifications of each unit. There's energy simulation modeling that's IRS approved. And then the certification must be accredited by a ResNet or equivalent, which is just another certification in and of itself. But starts with the provisional assessment. $45L goes 2 ways. So there's something for everyone. So if you are a developer of homes and neighborhoods, and you develop the neighborhoods and then you sell them to somebody, similar with condos, you are the one that is building the energy efficient property, you can get $2,000 per unit, up to 5,000 now. Same with rented. If you build it, you don't sell it, but you're leasing it out, you're renting it, same thing. You get the credit. This is apartments, student living, senior living, townhomes. Certainly homes are rented too, so that home development might fall into the rented, but either way, you're covered. And here, it's kind of how the base and bonus credit are flushing out. So we talked about the base credit. And for single family, it's 2,500, manufactured is 2,500. And then the prevailing wage is what's changing it over to the bonus credit. So if you pay prevailing wages and apprenticeships, look at the multifamily. That's your apartments, senior living. You go from 500 to 2,500. That's a big gap right away. So they're really incentivizing this prevailing wage. And that's something that needs to be in consideration as you're building. And then the multifamily 1,000 from 5,000. That's really a net zero ready multi-home. Not tons of those are being produced right now. With that said, maybe the 45L will incentivize more of these type of multi-families that could get up to the 5,000. But I think immediately today, in the next couple of years, that $2,500 per unit, very attainable if you plan out and assess properly. Okay, this is my 10-minute call map or 10-second call map slide. Sky is the limit. 45L 3-story limit is gone in 2023. This is a big deal. Since its inception in 2006, 45L, you need it to be 3 stories or less. And I can never understand why you wouldn't want to incentivize all homes and all multi-units to be energy efficient. And here we are in 2023, and there's the limit's gone. So you can have a 4-story, a 5-story, a sky's the limit story, and be eligible for this deduction, this credit, excuse me. And then another big one that they changed in the IRA, affordable housing. There was a time when you didn't want to take the 45L credit or be incentivized because it would reduce the basis of the property and therefore reduce your low income housing tax credit. So those who are taking low income tax credit shied away from the 45L unless they had excess basis. Well, now in the case of affordable homes and affordable homes only, you can now stack. 45L will not reduce the basis. Now you can have your cake and eat it too. So calling that the affordable housing boom. How do you claim the credit? It's a form 8908 to be used against regular tax liability, not allowed for AMT, not a cash refund, current year with amended returns. You can go back in time, say, I forgot to take this credit, I didn't know about it, it was a tax offender, and now I know about it. You can in an open tax year, and we do it all the time. And that's a nice little amending because it, you have to wait 6 or 8 months. You get a nice check in the mail from the IRS. All right, that's 45L. We'll go to 179D. Is available for HVAC, building envelope, and lighting up to $5 per square foot. So there's that materiality. Qualifications: energy must be 50% below a reference point. Ash rate standard 90.1. The qualifications to get to that $5 are changing. It's really a sliding scale from 250 to 5. So again, you need to discover and assess where you're at and really where it's coming from envelope, HVAC, and lighting. Again, just like the 45L, 179D goes 2 ways. One way is private. You own a building, has a lot of square footage, you can go ahead and get that deduction. Got extended permanently, you can use a 3150, you go back to 2006 and grab all the deductions you might have missed. And then on the other way it goes is designers of nonprofits. So designers would be architects, engineers, maybe contractors who are building for healthcare nonprofit, building for government. You can get the deduction. So it goes two ways, something for everybody. And here's some case studies of that. The manufacturing facilities are privately owned, 600,000 plus square foot, got the full deduction at $1.1 million using gas fires, 13 SEER and LED fixtures. We have a lot of success in the new construction space getting the full deduction. And you might look at the square footage, it does rule the day in 179D. We go from anywhere from 25,000 square feet, the values there, and then we do portfolios that have tens of millions of square feet. So really there's something for everyone from a square footage point of view too. And then on the governmental side, do tons of schools. And now with the new IRA, we're probably gonna do tons of hospitals. Again, it's a square foot play. The designer, the architect gets the deduction. Again, some more examples. We have pages and pages of examples from elementary schools to senior livings to hospitals, parking garages. There's something in here for everyone to grab the 179D deduction. Here's the summary slide. So everything I've been talking about can be summarized pretty much right here. 45L, we talked about sky's the limit. We talked about basis reduction. And here it is. Remember in 2022, we didn't know if it was going to be extended or not. Now we do know what the IRA is extended and under the status quo. So $2,000 through 22, place in service in 23, things could get more interesting, maybe up to that 2,500, maybe 5,000. 179D, again, the same back and forth, a good summary recap. We talked about the nonprofit. So Indian tribal government, certain tax exempt entities now can get this, whereas before they couldn't. Again, status quo for 22. What we didn't talk about is a 3-year cap. You can take this deduction now every 3 years. It used to be you can take the deduction once on a building and you were done. So assuming you continue to put in energy efficient equipment, whether it's HVAC or LED lighting, you could revisit every 3 years and say, hey, did we do enough to take the deduction again? And there is an enhancement for REITs. There was a time where REITs, it really was an invitation for them to take. They've, just like the affordable housing, they've changed some rules and it's now been enhanced. And now it might be more attractive for REITs to look at the 179D to be incentivized to build efficiently. And who are the industry winners from the Inflation Reduction Act? It has to be, there's 3 of them: residential and affordable housing. The fact that you can now stack 45L and 179D, you couldn't do that before. The fact that low-income housing tax, so the affordable side of it, can now be stacked with 45L. That's a free all. And now we have this energy deduction allocation program where nonprofit, senior living, healthcare, government can now dole out this deduction. And so what that looks like, again, November 28th, big day. We're going to talk a lot more about what that is. And then square footage industries. And that's mostly on the 179D side. When the more square footage, the more incentive you get: manufacturing, hotels, casinos, parking, hospitals. And the last one, the non-for-profits and designers, again, you have that EDAP. And then with that, we talked about a little bit, the Section 48 energy credit. You can stack those two things, the 179D, the energy credit, maybe a couple other things too. In the nonprofit space, it's a brave new world. Nonprofits haven't experienced this. And so we are in the process of figuring out what this looks like. Again, November 28th, we should have some better answers. This is my last slide, and we'll turn it back to Amy to wrap up. So to get started, I talked about discovery. The IRA, I don't know what it has to do with the Inflation Reduction Act, but it has a lot to do with energy and a lot to do with tax. And so you need to gather advice from CPAs. You need to gather advice from professional engineers, from HERS raters, the residential side, and then from people like Mel and Adam on Capitol Hill and partnership lawyers. You need all these people. Luckily at EB, we have all those people. In fact, we're licensed in all 50 states for professional engineers. So if you are a current client, and we have a lot on the call that are, we're going to be proactive in reaching out to you in these industries. And especially after this October 15th tax deadline, things are going to ramp up. Again, if you don't hear from us, you can be proactive too and reach out to your local office, the accountant you work with, or reach out directly to us and we can start that discovery process and see what's there.
So I think we're at the end of our hour. It looks like no burning questions. But maybe with that, just again, extend the invite. I think November 28th is going to be our kind of follow-up webinar on specific to tax exempts. And then we also have a webinar in December focused more on some of the individual provisions as part of the IRA, the electric vehicle credit and so forth. So please join us for those additional webinars. And I think with that, we can let everyone go.